Welcome to the advanced section of this course where I will be teaching the smart money concept or the institutional trading style as you guys know it as. But in this short video, I just want to give you guys a synopsis of why smart money concept is better than retail trading, where you guys learned about support and resistance, trend lines, and those stuff, right? So for me, the best thing about smart money trading is really understanding the movement of money in the market and getting those precision entries, right? So the reason why it's better to trade smart money concept is because retail trading is more probabilistic than facts. So it's basically you saying, I hope the market will turn here, I hope the market will turn here, or I hope the market will turn here. So it's not a sure thing. You guys just basically trading off the past. So this was a support in the past and you're expected to act as a resistance in the future or something like that, but it's not always the case, right? So it's basically you hoping that it's gonna be the case this time, right? And most of the times when these actually do play, it's because there is a smart money concept lying around within that same area. Because right here I can see a order block right here, which means that there is unaccounted orders left right here, right? So what I am saying is that if this order block, or if there was unaccounted orders left all the way up here, then the market would literally go through this resistance, retest, and then push back down. So you guys would have gotten stopped out right here, but luckily this order block is here, so it seems like this support and resistance is working. But nevertheless, let's look at some examples of why the retail trade why smart money trading is better than trading retail support and resistance and market patterns, right? So look at this right here. We had a double bottom right here, right? So technically, if you're a retail trader, this would be a reversal pattern, right? And when trading reversal pattern, you would basically wait for the market to break this resistance, right? Break this resistance, and then you get a retest. So it's something like this. So support, resistance broken, turn support, right? And then to the future, right? But the market left unaccounted orders here, right? Because this momentum move right here that broke structure, that was some money that fueled the market to actually break this structure. So there is unaccounted orders left right here after money has been transferred. You guys won't understand all these terms right now, but it's just me explaining to you why smart money strategy is better. So as a smart money trader, we would have waited for the market to actually come back here to actually collect these orders, right? And then push to the upside. So a retail trader would probably catch this trade, but they would have to be risking more, right? So the risk to reward is one reason why it's always better to trade this way, right? Because if you entered here, then your stop loss would be below the structure right here, and that is like a 20 pip stop, right? If you were to extend it here to the previous structure, previous high, that is a 1 to 3, right? A 65 pips getting a 1 to 3, that is a no, right? Smart money trader, however, would be taking entries here, right? Stop loss below this order block right here, right? And we would be getting like 1 to 14. So a 1 to 14 compared to a 1 to 3 with insane distance, right? Same trade, same everything, but the risk to reward is greater, right? And next thing is that trend lines, right? So you're trading based on a trend line, right? The market came down, the market broke the structure right here. What do? You take a buy because the trend line is broken? No, right? Once the market is still creating lower highs, you're still in a downtrend even though the trend line is broken, right? As a smart money trader, right, I see this. I see the market broke structure aggressively. So I see this break of structure right here, right? A retail trader see this break of trend line. I see this break of structure and I see market pushing up correctively, meaning that the momentum is not to the upside. The momentum is still to the downside. However, we need to correct ourselves. We need to correct this movement and account for all of those orders before continue pushing down. And note, even though the trend line is broken, even though the trend line is broken, we're still creating lower highs. So we're still creating lower highs. So we are still in a downtrend, right? And there is a unfilled gap right here that I would take my entry base off, right? So there's an unfilled gap right here. So that would be my entry with 50%. I think this right here could be less than 2 pip stop or maybe 2 pip stop. So 50% of this and extend it above 2.7 pip stop loss, and then target wherever we get the target on the 1 hour or whatever the case may be. So we're looking at 1 to 30, 1 to 36, 1 to whatever, right? So retail trader would have lost this trade because we broke this trend line and we got that retest, and they would say, hey, change because the trend line is broken. No, once the market is still creating lower highs in this downtrend, you're still in that downtrend, right? Even if the trend line is broken. So this is why I say support and resistance and the retail trading is really probabilistic than facts, right? However, if you understand support and resistance to a level and you understand structure, you can be profitable from it, right? All right, so look at this next example now, right? So this is a double top pattern, right? All right, so you would have gotten your entry, or the retail trader would have gotten an entry here and extend it. Maybe they got a target on the 4 hour or whatever the case may be, or the 1 hour time frame, and they extend it all the way down. But look at this, before you could actually go like a third in profit, the market came back up aggressively, take you out, and then push to the downside, right? Smart money trader know that there is liquidity above this equal high, right? And we'd actually wait for this equal high to be cleared before we take an entry, right? And even if you miss this entry, say over here, right? So this is a lot of equal highs, right? Or triple top, whatever the case may be, right? You guys would have entered maybe on this bear engulfing pattern right here. Right here, and the close of that bear candle and stop loss above, right? So when you guys see this huge push to the downside, your stop loss may be in profit, maybe here, right? Because you're saying the market not coming back, right? But smart money trader now, our entry would be right here because this is an order block, right? And if this is an order block, then that means there is unaccounted orders left right here. So our entry would be here and stop loss above our order block, which is what, 2.2 pip stop loss, and then we have extended to our target 1 to 43, 1 to 50 maybe if you hold this, right? But if you're a retail trader, if you got your entry here, your stop loss would have to be above structure, right? And then you get a 1 to 7 when I get a 1 to 40 something. So the risk to reward is always greater once you know exactly where to enter, once you get those precision entries, right? And that is what smart money trading is all about, where you can get those precise entries, right? So that is why it is better to trade smart money strategy, because it is more facts than probability, right? So I'll see you guys in the rest of the course, and I hope you guys learn a lot. So I'll see you guys next video.